Bloomberg Audio Studios. Podcasts, radio, news.
Shares of Alphabet just soaring in the after hours right now, Carol. Higher after the company reported earnings. Up as we speak, another 13.6% in the after hours right now. This after declaring a dividend, boosting a buyback, authorizing a repurchase of up to an additional $70 billion in shares. First quarter ad revenue coming out above expectations. First quarter, also declaring a cash dividend of 20 cents per share.
All right, so let's get to it. James Cakmak, so much to talk about. He's partner and technology analyst at Clockwise Capital. He joins us from Miami. First of all, Alphabet feels like I can't find anything wrong here. Walk us through. Is this just kind of firing on all cylinders, and if you will, and then just throwing on a dividend and then throwing on an additional buyback?
Yeah. First, thanks for having me. For Alphabet, this was a tough one, because we had the Meta earnings last night, uncertainty as it relates to the sustainability of the top line growth metrics. And obviously Alphabet via Google had, uncertainties around their search business. And at the same time, this growth in CapEx spend, is that going to translate over? So, we were kind of debating what to do. And going into the quarter, we actually rotated a portion of our Microsoft position to triple up our Alphabet position. So thankfully that worked out. But I think the key for Google, they're both up. So, it worked out. But
so why did you do it? What was it that you saw, James, in the Alphabet story that you said you wanted to do that?
Well, the main thing was the relative valuations. The expectations for Microsoft were exceedingly high, and the expectations for Alphabet were exceedingly low. And you look at one's trading at 22 times earnings, and the other one's at 35 times earnings. So you know what kind of the risk reward is, and especially we had some sense of how things might trade if they came in on a bear kind of narrative, given how Meta traded. So. It really just boils down to that. But the fact that Microsoft was able to exceed those nosebleed expectations is a testament to the trends and the force of trends that we're seeing in the shift to the cloud and AI more broadly.
Hey, I just want to get your thoughts on Snap, because it's a company you've been covering for years.
We love to ask about that every time.
Through the good and the bad. Well, the reason I'm asking is because shares are up, surging as we speak by more than 20%. 25% at this point. Yeah. This is after the company reported.
They are down 32% year to date.
They are. That's important context. The company is seeing second quarter revenue from $1.23 billion to $1.26 billion versus estimates of $1.21 billion. As Carol mentioned, it's been a brutal year so far for Snap. How are you reading into these results? And you don't own Snap anymore, do you?
No, not for a long time. With Snap, they were supposed to be the camera company and transformed into, exactly what they were initially, just messaging and some content initiatives. But at the end of the day, I think it's really, really hard for these niche platforms to scale in the manner in which is necessary to provide the differentiation to advertisers and the return objectives and return enhancements on that ad spend. So I think that the disparity between these niche platforms like a Snap versus the likes of Alphabet and Meta will only increase from here. The caveat being that you have companies like Pinterest, which we used to own but sold, just given the fact that they had our target, have more opportunities because of the engagement that they bring that is likely to grow over time versus, stick to a more static rates, which is from the likes of Snap.
All right, we've got to go back to Google. Forgive me, Alphabet. I keep calling it Google, but I mean, of course, Alphabet. I know. Up 12.5% here, folks, in the aftermarket. This stock heading into it had about a 12% gain on the year here in 2024. The stock was up almost 60% last year. But, when you look at Alphabet, James, and you look at its business lines and its roles and its play, whether it's AI, whether it's still advertising in a big way, our own Mandeep Singh saying, this company is all about engagement. That's kind of so valuable. And that's going to be valuable certainly in terms of machine learning and Gen AI. This is really important stuff. I mean, how do you think about, Alphabet in kind of its future growth trajectory and kind of where it goes from here? I mean, these are is a pretty impressive report. But it's also, right, appeasing investors of saying, we're going to throw some cash back to you.
Absolutely. I mean, anything with respect to returning capital to shareholders or, getting religion on the cost side of their business and utilizing their cash flow for more constructive purposes rather than throwing it into black holes, which is the way that they have been operating for as long as I can remember. That being said, I think that the future for Alphabet and Google, still remains a question mark. We don't know, and I don't think anyone can definitively say what that search environment experience is going to look like in the future. If you look out 5 years down the road. Now, the good news is all of this stuff seems to be like coming at you fast, right? All the AI, since January of 2023, it's been coming hard and fast. But the good news is on the behavioral aspect and the consumer experience, things have changed with ChatGPT and whatnot, but things aren't changing that fast overnight, which affords Alphabet time to really figure things out, whether it's cannibalistic to their existing search business or not. I think we have time. So I think extrapolating too much too soon is a risk. So as long as they have the time, they might figure it out. They may not, but they might. But James, I look into 2024 and 2025, and that's it.
Could critics argue about Alphabet that declaring a dividend and boosting a share buyback potentially isn't the best use of money right now? Perhaps they should be investing more in AI. Perhaps they should be investing more in making sure this search product is bulletproof.
Yeah, I mean, they're throwing off tremendous amounts of cash as it is, and they're investing a lot. And you look at the margin disparity versus a Meta, they have a lot of cushion there. And they're investing strongly as well. So I don't think it's mutually exclusive. So long as the ball continues to move forward, which is what we need to see, and we'll see what the color commentary is on the call, I think it'll be okay. I think the longer term is where the questions linger. Shorter term, it'll be fine.
All right, so let's go to Microsoft because it's also the other big one, or one of the big ones after the close. It's up about 5% here in the aftermarket. This one, sales and profit beat expectations on robust AI demand. That's the headline on our story. So quarterly sales and profit climbing more than projected, lifted by corporate demand for Microsoft's cloud and AI offerings. Revenue, as we said, up 17% in the third quarter, $61.9 billion, profit $2.94 a share. Analysts on average estimated per share earnings of $2.83 on sales of $60.9 billion. So again, outperformance here. And we know that Satya Nadella has been really infusing all of Microsoft's entire product line with AI technology thanks to its partner OpenAI. So thoughts on Microsoft, what we got here in the quarter, what it tells you about their business today and going forward?
Yeah, what's most amazing to me is the fact that they're able to maintain the growth rates no matter how big their revenue base gets. And the fact that they're able to deliver the numbers that you just cited and do so in an efficient way where earnings are continuing to grow at the same rate. So it's not there's no contra indicators on sales versus spending. So I that to me, the sustainability is the biggest and most impressive component of their operations. And most importantly, broadly, I think you can extrapolate that the themes on the data center spend and the semiconductors like the NVIDIAs of the world and the direction of corporate enterprise and their appetite for shifting from analog to digital is as strong as ever. So I think it's a very, very good omen for a lot of these companies and being at the center of it. Because you can make any analogy that you want. We're in the first inning, third inning, whatever. But right. I think the main thing is that the world is going to, I think Sam Altman had this quote that he said, the technological changes that we've seen over the last 500 years, the changes over the next 50 years will be greater than the technological changes over the last 500.
Right.
So that's the pace of change that we're talking. And a lot of that's going to come in the first decade. And these companies are all at the epicenter of it.
Just want to point out Azure, Microsoft's cloud computing unit, revenue gaining 31% in the quarter, above an average prediction of 29%. So picking up slightly from the 30% growth in the previous period. So, that's a trend line. If you're following it, right, you want to see.
I mean, there's a chance we see both of these, depending on what happens, there's a chance we see both Alphabet and Microsoft hit new records tomorrow in today's trade, depending on what happens. Okay, I want to talk, James, just a little bit about Microsoft's legacy here and the way that it's been able to shift and embrace AI. Where's the most important part of looking at Microsoft's growth moving forward? I mean, we obviously know Azure is incredibly important, but the company has made a huge bet on AI with OpenAI. Where do you start to see that investment and its relationship with OpenAI manifest in earnings?
I think it's going to be, exactly, you'll see it in the Azure business, but more broadly in the intelligent cloud segment. I mean, it should continue to translate on that front. But it's not just that segment. It's going to feed into other parts of their business too. On their subscription side of their software services and potentially even gaming. And, so there's a lot of levers, I think, that will be pulled from that relationship. And as the world and corporate enterprise continues to move in that direction, more data is going to feed into it, which is going to fuel even more efficiency with respect to the capabilities that they do. And, Copilot, for instance, is just on the, I don't want to keep saying first inning, day two of its potential. So, and there's a lot of money to be made there that you'll see that I don't think is being appreciated at all, virtually at all right now.
These are all different companies, but they're all working on AI. And to a certain extent, they're competing with each other when it comes to that technology, no question. Given what we're seeing from shareholders in reaction to Microsoft and Alphabet today, and given what we saw today in the session from reaction from investors to Meta Platforms sending shares for their worst day in months, what did the two companies that reported today get right? Or maybe a better way to ask is, what did Meta Platforms get wrong?
What did Meta Platforms get wrong? I think what they got wrong was largely related to the management of the expectations. There was no indication around the pace of investment that's necessary to sustain the kind of growth. I mean, they talk very qualitatively about this is a big opportunity ahead, all the metaverse and yada, yada. But there was no pushback whatsoever on the questions and commentary with respect to, how we should expect the pace of investment to ramp to justify and capitalize on the trends that Zuckerberg talks about. So I think it was more of an expectation versus reality mismatch that probably could have been better managed.
All right, let's just remind everybody the big earnings after the close and those that have really outperformed here and showing some stunning moves to the upside. Microsoft among them. That stock, as we mentioned, it is moving up just about 4.4% here in the aftermarket. And the company coming out, sales and profit beating expectations, lifted by corporate demand for the software makers' cloud and AI offerings. We talked about Azure gaining revenue alone, gaining 31% in the quarter. That was above analyst expectations. Revenue in the third quarter overall up 17% to $61.9 billion. Profit was $2.94 a share. Analysts on average estimated per share earnings of $2.83, so below what they actually came in with. And the estimate for sales was $60.9. So again, really hitting it out of the park when it comes to those estimates. And that is certainly one reason why you're seeing the stock, or a big reason why you're seeing the stocks up, the stock of Microsoft, I should say, up at the aftermarket.
Okay, let's repeat a little bit of what we saw from Alphabet. The company's first quarter Google ad revenue coming in at $61.66 billion versus estimates of $60.18 billion, and the company authorizing a repurchase of up to an additional $70 billion worth of shares, also declaring a cash dividend of 20 cents per share. First quarter revenue, excluding traffic acquisition costs, $67.59 billion, beating estimates of $66.07 billion.
To the downside, Intel. Shares are down more than 8% here. Biggest maker of PC processors, lackluster forecast from the company for the current quarter, indicating it's really still struggling to kind of find its way back to the top, if you will. Sales in the second quarter will be about $13 billion. That compares with an average analyst estimate of $13.6 billion, according to our data here at Bloomberg. Profit, again, the outlook will be 10 cents a share minus certain items versus a projection of 24 cents. So that's a pretty big miss. We're talking with James Cakmak, partner and tech analyst over at Clockwise Capital. James, is there some underlying theme? We're not through all the Mag 7 companies. We've got Amazon next week. And,
we got NVIDIA in a while.
Right. Yeah. So we've got some other plays to get through.
Next month, NVIDIA.
Is there any themes that you're finding, certainly for the investment community, when it comes to especially these big tech names, the Mag 7 often, who haven't always been so magnificent as of late, what they're saying and kind of their impact on the overall market? Is there some big takeaway here for you?
I think the biggest takeaway is that the sellers of these data center services are the best place to be. From NVIDIA to Dell, those are the server side. Like we own VRT, which helps with the cooling systems, comfort systems. So there's a lot of these companies that play into building out the companies that are selling to the hyperscalers. I think will continue to be in a great position. Now, as far as the Mag 7 is concerned, I do think, the market is still in a state of choppiness and volatility. And I think that's going to last until we have better clarity on what the Fed is going to do. And you saw the GDP numbers today. So there's mixed messages as to which direction macro is going versus tech and which one to prioritize. Because if you prioritize the economic cycle, then that means valuations are at risk. If you prioritize the tech cycle, that means that earnings are the focus. And right now we're in this world where some days valuations are in focus and other days earnings, like today.
Hey,
so I think you just got to stay nimble at the end of the day.
Hey, James, last question, 30 seconds here. I'm looking at Time U.S. equity on the Bloomberg terminal. This is the Clockwise Core Equity and Innovation ETF. It is up this year, a whopping 18.3%, outperforming all the benchmarks. Amazon is your second biggest holding after T-bills, accounting for 5% of the portfolio. We got Amazon coming up. 30-second preview of Amazon.
Yeah, Amazon, it's the only of the Mag 7 that we feel that we haven't cut exposure to. It's a 5% or give or take weight, and we're maintaining that. I think the data that you saw from Microsoft and today as it relates to the cloud is a very good omen. They're firing across all three of their businesses, on the grocery side, the retail side, the cloud side, and this is the first time in a while that you've seen everything going in the right direction, and most especially on the margin. So, we like the risk reward here. I think next year you could get to 225. This year probably upwards of 200. So, it's one that definitely keep in the portfolio for sure.
All right. We're going to leave it on that note. Hey, James, thank you so much. James Cakmak, partner and tech analyst at Clockwise Capital, joining us on Zoom from Miami. A lot of names moving here in the aftermarket.